Alright, listen up, Zoomers, because everyone out there is currently prepping for a recession like it's the actual end of the world. The news cycles are screaming doom and gloom, your Uncle Barry is probably hoarding canned goods, and the general vibe is just bleak. But guess what? While 99% of people are hyperventilating into a paper bag, the truly rich, the smart money, the ones who actually understand how this capitalist machine works, they're just polishing their yachts, ready to snap up everything on sale. Because for them, recessions aren't a threat, they're the ultimate clearance sale. They're when real wealth is transferred from the emotional and unprepared to the rational and strategic. And today, I'm going to pull back the curtain on how they do it. This isn't about avoiding losses, it's about making unprecedented gains when everyone else is taking a massive L. So grab your oat milk latte, settle in, and let's get into the recession playbook the elites don't want you to know about. ### the recession playbook myth, why everyone else loses. First, let's debunk some boomer-level myths. Forget what your parents told you about holding tight or waiting it out. That's simp behavior. The core truth about recessions is that they are cyclical. They happen, they suck for a bit, and then they end. The market always recovers. Always. Every single time in recorded history. Yet, most people lose money. Why? 2 words, emotional stupidity. People panic. They see red numbers, they hear scary headlines, and their lizard brain screams, sell. Sell everything. They sell at the bottom, lock in their losses, and then sit on the sidelines, paralyzed by fear, while the market inevitably recovers and leaves them behind. They lack a plan, they lack conviction, and frankly, they lack the foresight to see opportunity where others see disaster. They treat their investments like a hot potato, rather than a long-term strategy. Smart investors, on the other hand, understand market mechanics. They know that fear creates opportunity. They understand that asset prices diverging from their intrinsic value during a panic is literally a gift. They don't try to time the bottom perfectly, because that's impossible, but they do position themselves to accumulate high-quality assets at deep discounts. It's not magic, it's just basic economics and psychology. So, how do you ditch the panic and embrace the profit? It starts before the crash. ### Phase 1, Accumulation, Preparing for the Fire Sale, Pre-Recession. Okay, so how do you even get ready for a fire sale when you don't know exactly when it's gonna hit? Simple, you perpetually prepare. Think of it like building a financial bunker, but instead of canned beans, you're stacking cash in strategic assets. 1. Cash is king. Again ***, your emergency fund isn't just for losing your job, it's for opportunistic buying. Seriously. You need a significant amount of dry powder, actual cash, sitting ready. We're talking 6 to 12 months of expenses minimum, but ideally more, specifically earmarked for investment when the market craps itself. This isn't just about safety, it's about firepower. Imagine getting Tesla shares at a 70% discount because you had cash waiting. That's the kind of emergency fund I'm talking about. 2. Debt annihilation ***, especially high-interest debt. Credit card balances, personal loans, nuke them. Being debt-free before a crash means 2 things. 1, you have fewer financial obligations sucking your capital, and 2, your money can work for you, not just service some bank's interest. It clears the runway for pure investment plays. Don't be out here trying to buy the dip while still paying 20% interest on your old PlayStation purchase. That's just financially illiterate. 3. Identify your targets ***, don't wait for the crash to figure out your shopping list. That's simp behavior. Do your research now. What do you actually want to own when prices drop? We're talking blue-chip stocks with strong balance sheets and consistent earnings, think Apple, Microsoft, Google, Amazon. Broad market ETFs, like VOO or SPY, that track the S&P 500 are also prime targets. Maybe you're eyeing a rental property if you've got that kind of capital. Have a watch list ready. Understand their intrinsic value, not just their current stock price. 4. Portfolio rebalancing and de-risking **** before the actual crash. It's wise to trim some of your more speculative, high-beta assets that might get absolutely slaughtered. Lighten up on overvalued sectors or individual stocks that feel toppy. This isn't about market timing, it's about having dry powder and reducing your overall exposure to the most volatile parts of the market so you can deploy that capital more effectively when the real buying opportunities emerge. It's about having conviction in quality, not just chasing the hottest meme stock. Phase 2, the fire sale, buying when blood is in the streets, during recession. Alright, the market's bleeding. Everyone's panicking. The news anchors are doing their best, we're all gonna die, routine. This, my friends, is your moment. This is when fortunes are made. 1. Understanding market psychology, and ignoring it ***. Wall Street isn't rational, it's a bunch of emotionally stunted adults reacting to headlines, Twitter trends, and their own fear and greed. During a recession, fear takes over. People sell indiscriminately, often at irrationally low prices, because they can't stomach the short-term pain. Your job is to be the calm, cold-hearted collector. Turn off the financial news if you have to. It thrives on panic, your portfolio thrives on patience and conviction. 2. Dollar cost averaging, DCA, but with a twist ***. DCA, investing a fixed amount regularly regardless of price. During a recession, you kick this into overdrive. Aggressively DCA into your target assets. Don't try to catch the falling knife, you'll just end up with a bloody hand. Instead, be ready to buy more slices as it keeps dropping. This strategy removes emotional timing and ensures you get a fantastic average price on high-quality assets that will inevitably recover. Every dip is a chance to buy more, cheaper. 3. Target quality, always ***. When the tide goes out, you see who's swimming naked. Invest in the companies wearing full suits of armor, strong balance sheets, consistent profits, essential services, competitive moats. These are the companies that will survive the downturn and thrive in the recovery. Think established tech, utilities, consumer staples, healthcare. Avoid companies reliant on cheap debt or highly cyclical industries that get crushed hardest. 4. Real estate opportunities, if applicable ***. If you've got the capital and the risk tolerance, real estate can also go on deep discount. Foreclosures, distressed properties, over-leveraged landlords, they all create opportunities. But this requires local market knowledge and careful due diligence. Don't YOLO your life savings into a house without understanding the property's value, potential rental income, and your local market dynamics. This isn't for everyone, but for some, it's a massive wealth builder. 5. Broad market ETFs are your best friend ***. If you're not confident picking individual stocks, or you just want diversified exposure, broad market ETFs like VOO, Vanguard S&P 500, or SPY, SPDR S&P 500, are your ultimate "I believe in America" play. You're betting on the entire economy recovering, which it always does. These are low-cost, diversified, and highly effective for recession buying. Phase 3, the ride up, reaping the rewards, post-recession. So you bought low. Congrats, you absolute legend. But you don't just sit there counting your imaginary gains. The recovery isn't a straight line, it's often volatile and uncertain at first. This phase requires patience, but also strategic action. 1. Patience is a virtue, but action is king ***. Stay invested. Don't let short-term volatility scare you into selling your newfound treasures. The market will likely have false starts, pullbacks, and plenty of headlines saying, "Is this the end of the recovery?" Ignore them. Your long-term conviction is key. Continue to DCA if prices remain attractive, or just hold what you've accumulated. 2. Rebalancing your portfolio ***. As your recession buys surge, they might become a disproportionately large part of your portfolio. Periodically rebalance. This means trimming some of your biggest winners to maintain your desired asset allocation and risk profile. Don't let your biggest successes become your biggest risks. Reinvest those profits into other areas that haven't recovered as strongly or into safer assets if your risk tolerance has changed. 3. Knowing when to take tactical profits ***. While most recession buys should be long-term holdings, there's nothing wrong with taking some tactical profits if a particular asset has gone absolutely parabolic and become significantly overvalued. This isn't a full sell-off, but trimming 10 to 20% of a position that has 3x in a year isn't being a paper-handed sellout, it's being a smart investor. You can redeploy that capital into other opportunities or just keep it as dry powder for the next inevitable downturn. 4. Sector rotation ***. As the recovery solidifies, different sectors tend to outperform. Early recovery often favors cyclicals, industrials, and financials. Later, growth stocks and technology might take over again as confidence returns. Keeping an eye on these trends can help you strategically reallocate capital for continued growth, but remember, for most people, broad market exposure is often the simplest and most effective strategy. ###Risk management and mindset, don't be a moron. Listen, this isn't a get-rich-quick scheme. This requires discipline and a strong grasp of risk management. 1. Diversification. Don't put all your eggs in one crashing basket, even if it's a blue-chip basket. You think you're smart buying only one meme stock. Diversify, fam. Spread your capital across different companies, industries, and asset classes. That way, if one of your sure bets turns out to be a dud, it won't tank your entire portfolio. 2. Know your limits ***. Understand your personal risk tolerance. Don't YOLO your rent money or invest more than you can comfortably afford to lose, especially in volatile periods. This isn't financial advice, it's financial common sense. Be realistic about your capital available and your emotional capacity for volatility. 3. Emotional control is everything ***. Fear and greed are literally your biggest enemies in the market. Train your brain, not just your portfolio. Stick to your plan. Don't get caught up in the FOMO when things are booming, and definitely don't panic sell when things are crashing. Detach your emotions from your money decisions. 4. Continuous learning ***. The market evolves. Stay informed, stay cynical, stay profitable. Keep reading, keep learning, and keep refining your strategies. The world doesn't stop, and neither should your financial education. ###conclusion. So, there you have it. While everyone else is stressing about the next financial apocalypse, you, armed with this knowledge, can be over here, sipping your oat milk latte, knowing you're about to make bank. Recessions are not just economic downturns, they are periods of massive wealth redistribution. They are the market's way of giving the patient, the prepared, and the rational investor an incredible opportunity to buy quality assets at fire sale prices. This isn't about hoping for a crash, it's about being prepared for when one inevitably happens. It's about having the conviction to act when others are frozen by fear. This isn't just about surviving a recession, it's about thriving, about building generational wealth while the plebs panic. So go forth, be prepared, and let's get that recession riz. The time to prepare isn't when the market is crashing, it's right now. Start building your dry powder, identify your targets, and be ready to feast when others starve. You got this. Peace out.